lucky to be born 70 years ago and to have lived through the greatest period in history, the best time in the best place. And it doesn't stand to reason to think that, number one, everything will always stay the same or get better. And I think we've had our best times. I don't enjoy saying it, but I think it's true. And I don't enjoy saying it to my kids. But, you know, the U.S. coming out of World War II was in the best shape in the world. We had the best of everything. We had an intact infrastructure, and we had great advances on the business side and on the science side. And we used to say, you know, when people were questioning why we were doing better technologically, our explanation was that our German scientists were better than the Russians' German scientists. But if you look at, you know, and I imagine a lot of people saying, well, when are we going to get back to normal? Like
they ask that question.
Like the 90s. And when I look at the 90s, it was the best of times. The economy did well. Companies did well. Management advances. Technological advances. Productivity advances. Inflation under control. Interest rates declining. Peace in the world. And it doesn't get better. And if, by definition, it doesn't get better, then there's a good chance it gets worse. Now, the other thing is this globalization is a very, very strong force. And, you know, when I was a kid, there was no such thing as a foreign car. I believe that the first Volkswagen came to America in '49, and I believe, if I'm not mistaken, they sold 2 that year. You can look it up. But all cars were American. And when you don't have open borders, then the workers in one country can be paid more than the workers in another country, even if the product is not superior. And that was the case. And I believe, for example, that the American car worker was the best paid car worker in the world, and he didn't make the best car in the world. And it was the latter fact that permitted the vacuum to be filled by foreign cars. And so I believe that, I said in the past, and I think it became true, that the American car worker would have to accept a declining relative standard of living. And I think that's true. That's just one example, but I think it's true many ways in our economy.
So globalization is one of the factors.
Very strong. Automation.
Things on your mind as you look into the future and come to this conclusion that perhaps it's not, or probably not, going to be as good as the past. What else do you worry about? What else, if you will, factors into your equation?
Well, when you combine globalization and the vast numbers of people abroad who want jobs and it will work cheaper than Americans, and you combine that with automation, which is a much stronger force than job losses that we hear about so much in this election season, you know, automation has been an enormous factor. You go to a factory that 20 years ago had 100 workers, today it has 5. And they don't make any of the stuff, they only keep the machines going. And I despair about where the Americans who worked in agriculture 100 years ago in the South and then moved to the Midwest to make cars and appliances 50 years ago, I worry about where they're going to find jobs. And this is a question that is not easily solved.
Can you draw a straight line, or at the very least connect the dots between the future not looking as good as the past in qualitative terms and the future not being as good as the past in quantitative terms?
Well, I do think that we will grow more slowly in the future than we have in the past. And I believe that will deny opportunities. It'll make it harder for government to do things. You know, I wonder, why did we live so well 60 years ago? We didn't have deficits. We had good public schools. They were clean. I went to a public school. I got a good education. Why can't you do that today? Why can't we build infrastructure in this country and so forth? You know, so I mean, a lot of it has come from a declining growth rate and from the inroads made by globalization. And now, the good news is that, and I travel a lot, and it's clear that the U.S. economy is the envy of the world. And so the things I'm saying are not only relevant to the U.S. We're in better shape than, I believe, Europe or Japan, for example. But everything is slowing down. Everything is complicated by globalization and automation.
If you enjoyed this video, please do me a favor, just hit like below and subscribe to this channel.
Mr. Wilson, I live in South Sioux City, Nebraska. My husband and I will have some new money in the early 80s of our lifehood. We have a daughter 50 years old who will inherit anything we have. My question is I also have a 4% interest on a mutual fund that is non-taxable. Are there any better ways to invest our money?
Well, those are tough questions. I mean, I run into friends of mine all the time where they come into a lump sum at a given time, and Charlie and I do not have great answers about investing sums of money for people who are not really active in the process. I mean, as we said earlier, if we were working with small sums now, we would start looking at a whole bunch of very small situations and some things that we might know how to do on a small scale. But for the average investor who wants to own equities over a 20 or 30 year period, we think regular investment in some kind of very low cost pool of money, which might well be an index fund, probably makes as much sense as anything. But it's important to keep the costs down. I have close to 100% of my net worth in Berkshire. I'm comfortable with it because I like the businesses we own. And but I didn't buy it at this price either. So I don't like to go. I never recommend anybody buy or sell it. Charlie, do you recommend anything?
I think if there's anybody in the room who thinks it would be very easy to come up with a one-liner for a great no-brainer investment tomorrow with a great slug of new money, I wish they'd come up and tell me what it is. We don't have any solution to that one. It's harder for us now than it has been at other times.
Yeah, there's been a couple of times. In 1974, there was something in Forbes, and 69, the reverse of that situation. And then I think I wrote an article for Forbes, I can't remember exactly when it was, about how equities almost had to be more attractive than bonds at that time, and bonds weren't that unattractive. I mean, every now and then you can say you are getting a great deal for your money in equities, or sometimes you can say you're getting a great deal for your money in fixed income investments. You can't say that now, so what do you do? In terms of new money, we find ourselves sitting and waiting for something, and we continue to look. But we are forced to look at bigger ideas. So if we were working with smaller funds, we'd be much more likely to find something than we are in our present situation. As Charlie says, we really don't have any great one-line advice on it. I wish we did. Go ahead.
The real long-term rate of return from saving money and investing it has to go down from recent experience in America, particularly equity-related recent experience. The wealth of the world can't increase at the kind of rates that people are used to in the American equity markets, and the American equity markets can't hugely outperform the growth of the wealth of the world forever. We ought to have reduced expectations regarding the future generally.
Because, we mentioned earlier, 53% of the world's stock market value is in the U.S. Well, if U.S. GDP grows at 4%, 5% a year with 1 or 2% inflation, which would be a very good result, I think it's very unlikely that corporate profits are going to grow at a greater rate than that. Corporate profits as a percent of GDP are on the high side already, and you can't constantly have corporate profits grow at a faster rate than GDP. And, obviously, in the end, they'd be greater than GDP. And It's like somebody said that New York has more lawyers than people. I mean, there's certain, you run into certain conflicts in terminology as you go along if you say profits can get bigger than GDP. So if you really have a situation where the best you can hope for in corporate profit growth over the years is 4 or 5%, how can it be reasonable to think that equities, which are a capitalization of that corporate profits, can grow at 15% a year? I mean, it is nonsense, frankly. And people are not going to average 15% or anything like it in equities. And I would almost defy them to show me mathematically how it can be done in aggregate. I looked the other day at the Fortune 500. They earned $334 billion on it and had a market cap of $9.9 trillion at the end of the year, which would probably be at least $10.5 trillion now. Well, the only money investors are going to make in the long run are what the businesses make. I mean, there is nothing added. The government doesn't throw in anything. You know, nobody's adding to the pot. People are taking out from the pot in terms of frictional costs, investment management fees, brokerage commissions, and all of that. But the $334 million is all the investment earns. I mean, if you own a farm, what the farm produces is all you're going to get from the farm. If it produces, $50 an acre of net profit, you get $50 an acre of net profit, and there's nothing about it that transforms that in some miraculous form. If you own all of the Fortune 500 now, if you owned 100% of us, you would be making $334 billion. And if you pay $10.5 trillion for that, that is not a great return on an investment. And then you say to yourself, can that double in 5 years? It can't. The $334 billion, it can't double in 5 years with GDP growing at 4% a year or some number like that. It would just produce things that are so out of whack in terms of experience in the American economy. It won't happen. So anytime you get involved in these things where if you trace out the mathematics of it, you bump into absurdities, then you better change expectations somewhat. Charlie?
Well, there are two great sayings. One is, if a thing can't go on forever, it will eventually stop. And the other I borrow from my friend Fred Stanback, who I think is here. People who expect perpetual growth in real wealth in a finite earth are either madmen or economists.